Welcome everyone to this new update. Today we are going to cover everything you need to know to survive a bear market, including strategies to adapt the best way possible. Before we're going to continue, make sure to subscribe to this YouTube channel and like this YouTube update if you enjoy the content. Yesterday we've posted the first video on YouTube regarding the ETH merge, and we're planning to go back live on YouTube soon as well. If you like what we do, we also have a trade ladder with the latest altcoin setups, market information and market analysis. You can try it for free for 1 week and the link can be found in the description beneath. Finally, FTX is our core sponsor on this YouTube channel and we are able to do a big giveaway. We're giving away 3 one-year memberships to our platform 8 Global, where I'm sharing my trading portfolio, trade IDs and more. In order to do that, you will have to sign up to FTX through the links in the description beneath, and then you will be able to win those prizes. We're going to cover everything surrounding the bear market today, in which we'll be discussing what a bear market means in the first place. Then we'll dive into investment principles, through which we are going further with 6 lessons we've learned on the previous bear markets, as I've been experiencing a few already. Primary lesson, of course, is to keep moving forward, as the real winners are made in an actual bear market and they reap their investments in a bull cycle. But let's first discuss what a bear market actually is. What is a bear market? Well, a bear market actually has no specific meaning, but is a name that investors have given to the phase of the market in which prices go down across the board, an asset-wide downtrend. The thing is, markets depend on the global economic situation. For example, if you are in a phase where the economy is doing well, then people borrow a lot of money, spend a lot of money, earn more, salaries go up, people spend more and people think about the future. People build up pensions and start investing. This economic prosperity causes several people to look at the economy positively, have confidence in purchases becoming more valuable over a period of time, and thus spend money based on the idea that within X time they can sell it for more money. The price of the affected assets goes up and thus creates a self-fulfilling prophecy, also known as a bull market. The other side of the story is the bear market, a time of higher interest rates when consumer spending is discouraged, people earn less and sometimes lose their jobs. This all contributes to having other priorities for your money than investing in assets. Prices of assets fall, people take their money out of investments and that causes further price declines. We could still be in one bear market, but definitely have been into one in the previous year, as the crypto markets have been correcting massively. Let's have a look at the history of the markets. Should this be the first time you are experiencing a bear market, I can well imagine that a lot goes through you. In particular, the thoughts of selling when your position is underwater seems logical, but are often the worst decisions you can make. In the economy, these phases occur very often. A peak phase, also bull market, is the exact opposite of a valley phase, which is a bear market, in order to return to a peak phase and so on. In the world of Bitcoin and crypto, the chart shows the several phases with massive returns on the upside, but also significant corrections on the downside. This is something we generally also see in other markets. The stock markets have been seeing peak and valley phases themselves, as you can see on the chart, but usually grant and take longer to regain what they have been losing. If you plug in the charts from commodities, oil or even Pokemon cards, you will be seeing the exact same, and even real estate have been seeing phases, but usually tend to have way longer cycles. In short, bear markets are normal transition phases in the global economy where you go from prosperity to a reset phase. All assets are revalued and then the game can start all over again. Here we are discussing some statistics of crypto bear markets based on the current data. First, the average bear market lasts about 250 to 500 days and the average price drop of Bitcoin is between 70 to 85% of the all-time high. Now you've got a bit of background in the different phases, we can start discussing investment principles. In this video, we will not go into the exact definitions of a bear market. Bear markets differ in length, type, duration, but the common denominator is clear, a prolonged period of price declines. But a bear market is not about the exact numbers, it's about being prepared in the most ultimate way to capitalize on these price declines. Because, therefore, price declines are much more common. In the remainder of the video, I'll take you through some of the lessons that have ensured for me that a bear market is not a moment where everything breaks down and you should be leaving the market, but rather this is the greatest opportunity to start building your own wealth. The basic principles are the following. Before we move on to the lessons learned, I want to talk to you about the basic principles of investing. In a world driven by capitalism, more and more investing in generational assets will continue to increase as long as either the amount of people or the amount of money continues to grow. For example, take another look at the S&P. Despite the short-term up and swings, the overall trend remains clear from bottom left to top right. An increase in appreciation and thus an upwards trend. The simplest way of investing in such an asset class is to wait for the right buying moments. Moments in the trend where you get a discount on the actual value of the underlying asset. These discount moments are bear markets. Investing in an ever-increasing asset class requires a different view of the market than the standard bull and bear terms. This is because these terms are associated with a market situation and therefore bring emotion. Whereas bear markets are normally seen as a bad thing, you should actually see it as an opportunity. Which means a bear market is the chance to buy an asset cheaper than the underlying value. So a first step as an investor is to focus on moments like the market we are in now, to scale up in an asset step by step and thus build a position for the longer term. We call this investment technique DCA, dollar cost averaging. Essential are the following keywords: downtrend and scale up step by step. Dollar cost averaging is a way of investing whereby you scale into positions during a downtrend. If the market continues to go down, you must always have capital available in order to be able to buy positions at lower valuations. In this way, you create an increasingly lower average purchase price and you will almost always end up with a good result with a longer investment horizon. You have two types of DCA, which are DCA in and DCA out. The rule of thumb is as follows. Scaling in during a downtrend and scaling out during an uptrend. Make sure you divide your investment capital among several pools where you can start to scale down each time should the price action give you that opportunity. This option is better known as buy when there's blood in the streets, a saying of the Rothschild family, the richest family in the world. It's about buying when other people are forced to sell, more on this will be discussed later, and the pain of others is the strength of you. Or perhaps the most famous saying is, be fearful when others are greedy and greedy when others are fearful. Now that we've talked about the basic principles of bear markets and investing, it's time to take you through my own lessons learned over the past few years to make sure that you don't have to make the same mistake as I did. I've divided the lessons into the following 6 categories. First of all, structure, keep it simple. Then second is leverage. The third one is profit and loss. Fourth is passive income. Fifth, distancing yourself from your situation. And sixth is learning and development. I'll take you through the topics and offer advice that helped me get through the bear markets, including the current one, in no particular order. First of all, structure and keep it simple. I know the storyline. The more you dive into crypto, the bigger and more interesting it gets. Trust me, before you know it, you are with 3 exchanges, have a MetaMask wallet, a ledger and are reading about the Ethereum merge or watching our video from yesterday. Crypto is a combination of all these things where the different mindsets about trading and investing can cause you to try many things and simultaneously lose the overview. To prevent this from happening to you, I want you to do the following. Before you start investing, do some research on what you want to do and why you want to do it. The reasons behind your choice will bring you to the right platforms and not the other way around using 4 different exchanges. This way you can keep the overview. Then second, make sure you analyze your own actions. Use an Excel sheet or a portfolio analysis tool, calculate the percentages of your holdings of your trading portfolio and make everything transparent. Insight and data gives you control. There are 2 important keywords which stand out. These are overview and insight. Make sure you have those at all times. The second topic is leverage. And as you have undoubtedly gathered, if you have been active in the markets recently, the hassle surrounding CeFi has been taking its reaction to the markets. There was in fact the following taking place. CeFi works in exactly the same way as banks did in the early years. In order to collect money, they offered their customers the possibility to save money at the respective bank for a certain interest. These banks then lent out the money again or trade it to earn a higher interest than the 6% that they did or the ones that they gave, which is the profit margin. Money is a game of trust. In a bull market, everybody is confident and there's plenty of money, But the moment the sentiment changes, the situation changes. As you see in the example mentioned earlier, banks give away loans or trade with other people's money. Two big things can go wrong here. The first one is leverage, and leverage ensures that you can trade with leverage, of course. However, leverage works with a liquidation price, which happens when the price of the purchased asset decreases in value while you still have a loan, which is the leverage based on initial value. The moment the price falls too far, there comes a time when the leverage provider says, the risk is too big, I want it back. And in trading, this often is a fixed price, also called a liquidation price. If the value of initial investment falls to this liquidation price, you lose your position. This has been happening with a big party called Three Arrows Capital. The second one is the cash position. By lending out other people's money, there is only a limited percentage of the money actually in cash. During a bear market, consumer confidence declines rapidly, and if people then realize the money is safe in another place, they may decide to withdraw the money from the exchange. If the majority of people do that simultaneously, the exchange bank does not have enough money in cash, thus becomes a forced seller of assets and risks bankruptcy. And we know this case from Celsius, which has been having a tough time. The lesson of the story is about leverage and being a forced seller. Although during bull markets everything always seems to go well, without too much risk anywhere, during a bear market this can change quickly. You must at all costs avoid ever becoming a forced seller, and you do this by not using leverage. The third one is profit and loss. A trend gives a clear direction to the market. In a bull market this gives few problems, given that many people make a lot of money, and apart from taking profits on time, few nasty things will happen. Bear markets on the other hand are different. A downtrend is often accompanied by many losses, anger, wrong influences and wrong choices. Trading and investing is about moving with the trend and getting out when the trend turns against you. In a bear market it's important to protect yourself more, especially with trading. Take profits earlier, keep your stop losses shorter, but also make sure that you start building up your capital and not losing it. Essential is the preservation of capital. The winners of the next bull will be made in the bear market. The fourth one is passive income. The ultimate goal of investing is to accumulate as many coins of a particular asset as possible to ultimately profit from it when the market turns around. You can do this by actively buying when prices fall, but also in the passive way. Make sure to stake your coins at all times. Staking is a way of passively earning income by acting as a validator on a blockchain. Often you can't be a validator yourself because it requires a certain portfolio size, so you look for an intermediary who can arrange this for you. Exchanges like Binance can do this, or for example a decentralized staking provider like Stakewise. There are two intermediaries you can use, a centralized one like Binance or Kraken, where you can just use it for example, or decentralized staking like Stakewise, where you can just put them. Make sure you collect as many coins as possible if you are an investor. The fifth one we are discussing is distancing yourself from your situation. One of the perhaps most important lessons of the current bear market is the importance of keeping an overview. For example, look at the situation with Terra Luna. Although so promising, in the crypto world something can always go wrong. You should therefore see altcoins more like research and development, very promising but with a high chance of failure. It is very unfortunate, but people who are purely focused on how promising an algorithmic stablecoin from Terra could be were not accepting the fact that there were several risks of this concept. Consequence, the wipeout of your entire portfolio or a part of it. So make sure you always look at the current situation from a distance. How much percentage do you have in one coin? Where are the risks? Am I biased? Think about Bitcoin or ETH maxis for example, and being a maxi is never a good thing. Analyze, learn, improve and adjust. Your portfolio is a living thing. The final topic is learning and development. And actually directly building on the last point, learn and improve yourself in all areas. We are in an industry where knowledge and experience prevail. So absolutely do not let a drop in prices knock you out of the game, but rather deal with it by working extra hard on yourself. The long-term horizon will prevail. The developments around blockchain and the decentralization are world changing and will attract new users over time. New users will create new demand and eventually increase the price. So we are actually still at the beginning. As mentioned earlier, the winners of the bull are made in the bear. This is one of the most transparent facts of the crypto market, and make sure that you are ready for the next bull. In this short video, I've named some of my key bear market lessons. Of course, this is not everything. The industry continues to evolve and new lessons continue to emerge, and we'll definitely be sharing that on YouTube and on Twitter. Thanks for watching this update on bear market lessons and investing into the cryptocurrency markets, and make sure to hit that like button and also make sure to subscribe to this YouTube channel to stay tuned on the latest content. Finally, sign up to FTX to be able to win one of the prizes of our platform, and if you want to check out our content for free, the newsletter is your go-to place for 1 week. Stay calm and patient, and I'll see you again coming week in the live streams.